Hello, everyone, and thank you for joining. The iGen and Weaver teams are excited to present today's webinar, Avoiding Costly Mistakes in Fuel Tax Reporting. I'm Nick Millage, Vice President of Product at iGen, and your moderator for today. A quick agenda before we turn it over to our presenters. We're going to start with introducing the presenters and then move to framing the significant stakes in fuel tax. We'll then take a deep dive into common pitfalls our presenters see all too often. And then we'll wrap it up with plenty of time for QA and before providing next steps and resources. Kelly and Bob, can you share a little bit about your extensive fuel tax background before we jump into framing the stakes?
Sure, I'll jump in first. I'm Kelly Grace. I'm a director here at Weaver in the Motor Fuel Tax Department. I've been doing motor fuel taxes for about 15 years now, touched on everything from audits, consulting, compliance, lots of different companies I've worked with all different sizes, seen a lot of different things, and I'm excited to be here today.
And I'm Bob Donnellan. I've been working in this space now for 41 years. I started working for a private company in the Northeast. I then moved into some consulting down in Texas, worked on creating the new Virginia tax reporting system, and then found my way over to iGen 4 years ago and couldn't be happier where I'm at. I'm also the Federation of Tax Administrators Basic Training Motor Fuel Instructor.
All right, so to kick it off, why you guys are all here today. Obviously, fuel tax is complicated, and it's just getting more and more complicated. As states start to learn the matching processes, we're dealing more with flash titles, differences with counterparties, and all these things have major consequences if you don't get them right. Those include, and they're not limited to, penalties and cash leakage. So if you pay a tax that you shouldn't have, trying to get that back can be a challenge. Frequent amendments and prolonged audit exposures. For those of you who have entered into the state of Illinois, you know those amendments and you know they keep coming. Once you start going down the wrong path, it's hard to get out of it. And then finally, burnout and blind spots for leadership. So a lot of employees, if you are trying to get your compliance done, you're dealing with amendments, you're dealing with customer issues. It just causes more and more work to build up. And sometimes you feel like you can never get ahead and leadership is trying to figure out what's going on. And it just leaves everyone in a really bad spot.
Well said, Kelly. Well said.
Thank you.
All right, everyone. A poll should pop up on your screen shortly. So you can please take a moment to answer. Just give everyone a few seconds here.
All right, so far, it keeps moving. It looks like we have a range of amendments, Bob, people, what they're dealing with and everything else.
Yeah, exactly.
But
I
it does
noticed as well.
seem like a lot are in that 11 and plus. So probably a lot of you are in Illinois. All right, so I'm showing on my screen. I don't know if everyone else can see it, but we have around 26% between 0 to 5, 17% 6 to 10, and 11 plus at 57%. So this is definitely the right webinar that you are at.
We'll try to show you how, or give you some tools on showing you how to eliminate all of those amendments.
That's very confident of you, Bob.
That's the optimist in me.
I love it. I love it. All right. So we're going to take a deep dive. We kind of covered an overview of what we're going to talk about, but we're going to dive into common pitfalls and how to neutralize them. And we're going to start off with talking about diversions. So just, I don't know the range of people on here. I know some of you might have many years of experience. Some of you might be new to the industry. So Bob and I are going to try our best to make sure we define a lot of these terms to make it easier to follow along with us. So what is a diversion? A diversion is essentially a product that got pulled from the terminal, It has one state listed. For whatever reason, whether you learn that the product needs to go somewhere else, the storage where you're at is full, you end up moving it to another spot. When you do that, you need to file a diversion. And what I will tell you right away, and I've seen these bill of ladings, you see all this handwriting all over them, all this crossing out. The bill of lading is a legal document. All that crossing out, all that handwriting, that does not count for your diversion. You actually got to file it with the state. The problem with diversions is if you're not aware of them and you're not tracking them, you might end up over-reporting in a state and not reporting in another state. So now you have two problems happening at the same time with two different jurisdictions. Um, I will let Bob actually go into this next example here, the complex one. Gasoline purchased from a supplier at the Indiana terminal. The BLL destination says Fort Wayne, Indiana. The entire load of 8,500 gallons is delivered to Ann Arbor, Michigan. Bob, why do you think that would be an issue?
So what happens here is in Indiana, there is a tax at the rack, as well as there's a tax at the rack in Michigan. So if you're picking up fuel and you're paying based off of the destination, and the destination is Indiana, you're paying on a reduced tax rate in some cases. You're paying the wrong tax. If the load gets diverted, it should be registered with the diversion registry so that you can have a number on that bill of lading that will then tie back to your reporting, and it will eliminate the states coming back to you when they see this asking you what happened to the product. A lot of reasons this can happen. You could, the driver could go in and pull the wrong card by mistake, and it could be a driver's error. It could be that you were going to Fort Wayne and then your dispatcher called and said, no, I needed to go to Ann Arbor. We're running out of gasoline there. We need to get the gallons there sooner rather than later. We can backfill Indiana afterwards. So those are some of the reasons why this can happen. And again, it's the bill of lading is an information document that should be used as such and just help states identify where the product is actually going. And that would be done through the diversion registry. All states have access to the diversion registry because they all pay a fee to be part of it. And then there's a lot of industry that are also part of it. They pay a fee as well, but they get to pull down reports on a monthly basis, weekly basis in some cases, and they can identify these diversions sooner rather than later. And that will just eliminate amendments if you know about them sooner as opposed to later.
Bob, you brought this up when we were talking last. States love pulling up those original BOL documents. They love seeing all that handwriting all over it. It's like a little trail for them to look into potential issues. So,
Exactly. So what ends up happening is if you're under audit and the state auditor comes in and they ask you for a copy of the bill of lading, well, they're not asking the right person for that bill of lading, right? Because the bill of lading you're going to produce is going to be the one that was produced at the terminal, and that's going to be the one that you have. The driver, on the other hand, the one that's the bill of lading that is into the truck has, probably the driver's lunch all over it, as well as some spilled coffee and all kinds of notes. Those notes will actually dictate what actually the driver did with that load of fuel. And that's the bill of lading that the auditors from the states should be asking for.
and also something to keep in mind with registering these diversions, some states have a time limit on getting those diversions in. So you can't wait too long after that diversion happens before it's registered. That's also important for your tax preparers because they need to know what's going on in order to get that return correct.
Absolutely.
All right, let's talk about flash titles next.
So how many of you all know what a flash title transaction is? Again, I saw a list of some of the participants that were here, and I think we have a pretty broad range of novices to people that have been working in the industry for many, many years. A flash title transaction is a transaction that can happen simultaneously between 1, 2, 3, 4, 5 different parties. And a flash title transaction is not only going to be, as most people think, a rack state. Flash title transactions can also happen at a distributor state, first receiver state. Um, and we'll talk a little bit more about some of the potential issues that can happen with a flash title transaction. We just did talk about diversions. Sometimes a diversion within a flash title transaction can also complicate the situation a lot more. I can give you a couple of examples of some of these flash title transactions where you can have some potential issues. Again, the bill of lading is supposed to be a billing document or an information document, not a billing document. And it's supposed to provide information of what actually happened to the fuel. And let's say there's three parties involved. There's the terminal, there's you, and then there's your customer. And your customer has the ability to go in and pull a load of fuel under your account. So the terminal is now going to bill based off of the destination of your customer. So if your customer picked up fuel in, say, Indiana and had the destination of Illinois on that transaction, then the state is requiring you to show that you actually exported the fuel out of Indiana and into Illinois, because they're going to be charging Illinois taxes on that transaction. And the supplier is going to say that the transaction happened at the terminal in Indiana with a destination of Illinois, but yet you were never the one that actually moved that fuel. It was your customer, right? So you end up with some, what I like to call misreporting, because you're not actually reporting what actually happened with that transaction. Now, again, because this is a rack transaction, there are some states that allow discounts, administrative collection allowances, various other incentives for paying tax timely to the supplier or the position holder. And how do those get affected, and how do those transpire into what you're doing? And are you entitled to any of those collection allowances or administrative discounts, et cetera? Now, another problem you can run into is, well, what happens if you're buying ethanol and ethanol is not a taxable product in the destination state, and you're buying RBOB or CBOB, which is a taxable product in the destination state? So now you're going to have a bill of lading, and you're going to have a transaction where it was all sold to you at the destination, but yet you have part of it taxed, part of it untaxed. How do you go about making and collecting those taxes, right? So that's your typical flash title transaction on the rack side of things. What really has been transpiring over the years, and not too many people have been affected because it's easily mitigated, right, through licensing, et cetera, is I'm gonna throw a transaction into the Northeast here where we had product that was being purchased with the destination of going, it was a barge, it was going to New York Harbor. Now, there were 5 parties involved. And then in the middle of this transaction, all of a sudden, the end or the final purchaser says, I need this in Rhode Island. And I use Rhode Island for many reasons, because it's probably got the most stringent registration requirements, and it also has a 240-day refund for refunds. So you have a company now that's in the middle of this chain that is not a licensed distributor, and they try to get licensed, and the state denies them because they don't, quote, meet the requirements of being a distributor. So what happens is 3 of these transactions are first 2 of these transactions are tax-free. The third one becomes taxable. And then that third transaction would be, in normal circumstances, you would just pass the tax on to, customer number 4, and then customer number 4 pass it on to customer number 5, and then it would go into the terminal. And what ends up happening is number 4 says to number 3, I can't pay you the tax because there's no refund provision on my distributor return in order to get this money back. And number 5 says the same thing. I'm not paying it because I'm a licensed distributor in the state. I'm not going to pay you the tax either. So number 3 is is accountable for all of this tax. And it could be anywhere on a barge. It could be anywhere at 33 cents a gallon, million gallons. You could be looking at 300,000, anywhere up to, 5, 6, 7 million, depending on whether it's a vessel or just a barge. and the state walks away with all this money because there's no way for anybody to get the refund back from the state. And even if there was a way, you only have 240 days to file for that refund, otherwise you lose it. All right. One of the biggest problems with that type of a transaction is that if you look at the contract, right, because now we're going to contract law on a transaction, on a flash title transaction with the diversion. And the contract says, yeah, title is going to pass on the high seas. But yet, when it says the billing quantities are going to be based on short tank quantity and quality, how can you bill somebody if you don't know the number of gallons you're going to bill them at on the high seas, right? You can't, right? So the contract is saying one thing, but yet the transactions are saying another thing, and that's where you can run into problems. Kelly,
Oh, so
got
many,
thoughts?
lots of thoughts. And this was fantastic. Thank you, Bob, for those examples, because it does bring up a lot more. First off, just going back to the FTA booklet, what I'm noticing and what I loved being included is it's starting to address how the states are handling flash title transactions and what they want to see on their end and who's responsible for the tax and the reporting. And what you notice right away, states aren't all doing it the same. Everyone's a little bit different. Also, the states are trying to figure out how to communicate this because a lot of it has not been legislated yet. So they're trying to handle it in their handbooks or through the FTA booklet. You and I, Bob, talked about this issue in Washington where they were trying to address flash title sales in their handbook, and they said transactions that happen on terminal grounds are exempt between suppliers. Well, they were talking about flash title transactions, and they picked that up on their Schedule 6. Looking back at the statutes, if you took that as all transactions, even transactions that are pooled at the rack, then you would think, hey, everyone's licensed. I don't owe tax. But their statute says Washington is a tax at the rack state. You owe the tax and you need to report it. So there was a lot of confusion. Fortunately, we had a great contact at Washington who was able to kind of help sort this out for us. But that's just one of the many issues you can run into as the states try to address something that keeps happening more frequently, but the legislation hasn't quite caught up to it. And then another point to think about, which I run into all the time, is when you're going to do your reporting, I've noticed a lot of like ERP source systems don't have a way of flagging that flash title. So it looks like products just pulled at the rack and that's how you're handling it. You're not even looking into the flash title rules because there's no way of knowing. Now, I know you guys work with iGen. Has iGen thought of different ways to address this? Are you kind of stuck like we are?
Well, there are multiple ways to handle flash title transactions, especially if we've got multiple parties working within the iGen environment. We have tools that can help assist them in trying to identify certain transactions that might be a flash title transaction. But again, you're still going to have to do that extra step and take a peek at some of the transactions just to confirm. But we're trying to build tools that will assist this more instantaneously, I guess.
Mhm.
But again, it's as good as the data coming in, and that's how you have to look at it. Is you can only report what you see, and sometimes when you look at transactions, you can kind of get a gut instinct as to what you're looking at, whether or not you want to dig further into it. I've done that over my career, and I've been able to identify certain transactions. When you do this long enough, you can kind of spot some of the anomalies that would make you think that. Uh, but yeah, I mean, those are some of the problems that you have, especially with the mismatched BOLs. Yeah.
Absolutely. And it is a complex area. Nick, did you want to weigh in at all?
Yeah, I was just going to say another thing, with our flexible data engine, you can bring in multiple data sources. So you may have a BOL feed that doesn't, if reflects additional information that is not in your ERP system. And at that point, our reconciliation capabilities are able to do comparisons between the two. So there's a lot of different ways to do it. And you're really thinking through all of the sources that are at your disposal is very helpful.
Absolutely. All
Couldn't agree
right.
more.
Counterparty data mismatches. This is kind of broad, but it comes up in a lot of different ways. Probably the simplest way of thinking about it is you have a company, they go by different business names, and they might register under their doing business as name versus their common name. So that can cause a lot of different challenges because the state will come back and say, well, that person's not licensed. And then you have to go back and amend and correct the naming. We're also seeing states are working together quite a bit, and they will take your information and bump it up against each other. So if you say you have an export from Maryland to Virginia and you report the export on your Maryland return, Virginia is going to be saying, well, where's my money? And they will go to Maryland and they will know that you exported it to their state. I know as technology is advancing, and I'm going to say the dreaded or maybe celebrated term AI, I think states are going to get more and more sophisticated, and this process is going to become a lot easier for them to do. And what that's going to bring about is amendments. You might be reporting tax to the wrong place, and this you're going to have problems once again in two different places, potentially two different states.
And one of the things that we like to say, at iGen too specifically is, if you built yourself a workaround because of a transaction that you just don't have time to get to, we don't want you to keep building that workaround. We want you to identify it to us so that we can then go in and kind of correct it on our end so that when your data feed comes in, it's now coming in and there is no more workaround for you, right? We would rather you utilize the system to its fullest capacity, and we don't want you to have workarounds. Number one. Number two, again, when you get some of these, BOLs, whether it be a number, whether it be 5 gallons that are missing, things like that, or the origin or the destination name is spelt incorrectly. I mean, those are all red triggers to some of the states, especially Illinois. If you're doing something in Joliet and it comes across as Juliet, you're going to get a notice saying you need to file an amended return or you need to pay us, $3,000 in taxes. I mean, they don't play games. So those are the issues that we're seeing. We can build some of those discrepancies into our solution, such as name changes like that. If we see Juliet and we know it's Joliet, we can just automatically make that change happen. So there are some things that you can do with technology.
Absolutely. And I also always try to encourage our clients, obviously fix it in your reporting software, but also try to get it fixed in your ERP system, in your source, because eventually something might change. And if you have your source data clean, you're going to set your tax reporting software up for success. Bad data, you're going to struggle a little bit more. But I love that you brought up, Bob, communicate that, because I've known people who have spent hours manually correcting one by one name in a software that you could easily just tell it to correct itself. Um,
Absolutely.
and sometimes people don't know that's available. Sometimes they get busy and they forget about it. And then the next month comes and they're like, well, guess I'm doing this again because I don't want to risk a long turnaround time. So, but the sooner you reach out, the sooner your provider or your whoever's helping you can get this issue fixed and resolved. And you'll avoid some costly mistakes and some additional amendments, to say the least. All right. So next we are diving into some operational pitfalls, and we're going to start off with transloading and tracking.
So I don't know how many of you know what transloading actually is or why it even became part of our world in the fuel industry. Several years ago, probably more like 5 or 6 years ago, I guess now, uh, a lot of oil companies didn't have the capabilities and there was no means to build more terminals or more bulk plants across the country, right, due to environmental impacts, etc. So what ended up happening was the railroads transloading became a big play for the oil industry. As you know, rail cars can hold up to close to 30,000 gallons per rail car. And there could be anywhere up to, I don't know, 10, 15, 20 rail cars on a string of a locomotive. And what happens is they fill up these rail cars with fuel and then they bring them to a spur in various locations. So I like to kind of look at transloading as a moving storage facility that can be moved from one point to another. And then we have the transloading capability of discharging that fuel from the rail cars into a truck, right? So then you now have the complex structure of trying to determine how many gallons of fuel left that rail car that went into a different bill of lading. Maybe it was 3, 4, or 5 different bill of ladings, right? So they don't tie back to each other. Each rail car is going to have its own bill of lading. The transloader is going to be giving its truck a different bill of lading, and there's no way to connect the two dots, right? And when you're looking at 10 rail cars, and you've got 27,000, 28,000 gallons in each rail car, you're looking at what, 2.8 million gallons of fuel. How do you take that and tie it back into how many gallons came out of those rail cars and how much fuel is actually left in those rail cars, and what is an acceptable allowance for states to say, okay, we've accounted for all of this fuel? One of the things that we're working on at the FTA uniformity group is we're working on creating a schedule for rail cars so that they're easily identifiable. When states are looking at returns, they can just spot it right away. I don't know why they wouldn't think it would be easy or to have a schedule, because we all know with trucks, right, the maximum amount of fuel you're going to see in a truck is approximately 8,500 gallons. Anything over that, you're going to be a little suspect, right? Let's be honest, right? Because we know that trucks can hold 27,000 gallons. And then if they put it in as a pipeline, we're going to know that, well, 27,000 gallons really isn't a pipeline batch, right? So, I mean, we have some little leeway when, auditors, but again, when you've got all these new auditors coming in and all of this is thrown at them, they're trying to understand the complexities of their jurisdiction, right? Let alone everybody on this webinar that's probably dealing in 40 or 50 jurisdictions, right? You need to know, the tax laws of all of them, whereas these new folks coming in focus on just their jurisdiction. So you can have a lot of data mismatches. So they came to us and they were like, we would really like to have a schedule so that we can train our folks to look at certain schedules and try to reconcile the rail cars back to the truck disbursements, right, coming out of those rail cars. So that's the reason for the uniformity group at FTA creating it. And again, like Kelly mentioned earlier, one of the best resources I can give to any of you would be go to the state by contact book, look it up, look whatever you're looking for. It'll give you, it gives you an outlet to at least give you some visibility into what you're doing and what you're looking at. And then it also gives you a place or a point of contact where you can actually reach out to somebody and say, hey, I have this issue. How do I address it with your jurisdiction? If you run into situations where you don't find the question that you want to get answered, you could always email myself or Kelly or anybody at FTA, any of the subcommittee co-chairs, and we can get that question added to the book. And the book gets updated every September at the annual meeting. So we just need to know the questions so that we can bring them to the committee. So if you run across something like that, you want more clarification on a specific issue, please let us know.
And I love that. And I love that you're calling it a book, Bob, because I remember the days when I would go to FTA, grab a few to bring back with me, and I'd have to make sure my luggage didn't go overweight because that was a thick book and it's only getting bigger. Fortunately, now it's all online, so it's easy to get to, it's easy to search. It's just been such a great resource. And this issue right here is definitely a complicated one. And I appreciate FTA making the effort to kind of educate, because I will tell you, I've been through audits. If they're not clear what you're doing, they'll just assess. They will not take any more time to walk through. There will be no extra work. You'll just be fighting an assessment. So it's great that they're kind of working that out.
Absolutely.
All right, moving forward. Oh, I think we went, there we go. Everyone's favorite topic, reconciliations. This is usually always a giant project if you do not keep up with them. I have dealt with so many companies that don't do GL recons on a monthly basis, and they end up in a bad spot, whether their internal or external auditors start asking for it. Even states will come in and want to see it, and that to them, if you don't have it done, will be a red flag. Most importantly, though, if you're not doing your reconciliations monthly, you are taking a risk that you are not reporting correctly. And here we're primarily talking about the tax dollars owed, right? But it's also important to make sure you are reconciling your movements. That guarantees that you're reporting, or gives a better guarantee that your reporting is correct, that you're not missing things. I will say it's also important to go through and do a BOL by BOL reconciliation. And this is the age-old example. You can have five $5 outstanding. You're like, great, I could write that off. This is a large return. But you can always have 1 million going one way and 1,000,005 going the other way. So you actually have a big problem that's just being covered up with the credits and debits. And I've seen companies go through this. I've seen companies confidently say to me they have a giant refund due from the IRS and for us to go after it. And we start diving in. Next thing you know, that amount that's sitting on their account was covering up a lot of other problems. So it looked good just at a glance, but it turned out to be pretty messy.
And to your point, when I was doing when I was working for a consulting firm, we used to go in and I'd go in to look at a company. This one might have been in Connecticut, and I'd just say, "Hey, let's see your general ledger. You want me to tie them out?" And he gives me one general ledger account, which includes excise tax for gas, diesel, jet, all the environmental fees, any sales taxes. And I just looked at him and said, "And how do you propose we go about doing this?" And he goes, "Well, I wasn't allowed to create general ledgers for every one of my tax types because there'd be too many." So that problem number one, right? Number two, I went through and I identified where there was over $1 million in refunds coming back from the lovely state of Pennsylvania. So we went through, we filed all the refunds over a 3-year period. It was supposed to get somewhere in the neighborhoods of a little north of $1 million, I believe. Maybe it was just under $1 million. The state approved all of his refunds. However, they sent a check for about, I don't know, $48,000 or $58,000 and said that was all you were entitled to. And the reason they were entitled to just that amount of money was because there was a discount or a collection allowance that was given. And their argument was the collection allowance provided was for timely, which they were, but accurately filed tax returns. And because they weren't accurate, they took all of those collection allowances out of the refund and said you no longer are entitled to those collection allowances. Now, I know Indiana is another state that if you do file an amended return, they will automatically take back the collection allowance and you'll have to write to them and try to convince them to give it to you and to let you have it. If it's on a month-to-month basis, they might give it to you one time, maybe not more than that, because they're going to make sure you are very accurate in doing that consistently. Another issue you can run into is a lot of our invoices today, to the oil companies, they're all electronic. So once you set them up once, you don't see them again. And if you get major oil companies that change the back office system, you may have been exempt from an environmental fee, but then when they did the conversion and they started, reissuing you invoices, you don't see them. And if your environmental fees and your inspection fees are all being dumped into one account, they're going to keep growing. And you're not going to see where they basically net to zero, right? Because that's really what they should be, right? If you're paying it and then you're charging it, the net result should be zero at some point. But if you see balances continuously grow, you may have to go back and start looking at some of your invoices that are coming in electronically to ensure that they are being billed. There was no change in their back office system that allowed them to, miss this. I've had cases in the past where I've had to go back to certain vendors and say, "Hey, you've overbilled me by $148,000 and I need credit and rebills." And they were, "We're not going to do a credit and rebill, but we agree we owe you the 148,000. So here's a lump sum credit and we'll change our system moving forward." Again, those are all red flags, right? Those are like the states are going to say, "Why'd you get $148,000 back?" Right? Then you got to go back and you got to stop pulling all of these invoices that were brought in, and you got to kind of show them the reconciliation. So, I mean, there's a lot of things that can happen if you don't reconcile your ledger to your returns, and it's always prudent to do that before, right? Let's be a little proactive. We don't want to be reactive, because when you're reactive, then that's when things can get missed. So again, good data, clean data coming in, you're going to get better results in the end.
Absolutely. And going back to that example, Bob, with the environmental fees in some states will even expire and then reactivate at times. And if you are not keeping track of that, when they reactivate, you might be paying that out and you go back to your customers, try to recoup it. Well, the state's made whole. They don't care what's going to happen next. They don't care if you get your money back from your customers. And now you're in a contractual issue with your customer who you want to have a good relationship with, but they're saying, well, you should have told us sooner. We weren't ready for that. We didn't set that aside. And it just causes a lot of problems for a lot of people. And also, what I see all the time, and I've been on multiple ERP implementations, tax is usually the last one involved. They love going through everyone. The system's about to go live. They bring tax in around Thanksgiving with a go live date right before Christmas. And they're like, just tell us everything's perfect. So now you're trying to scramble and try to get caught up. And a lot of times the thing that falls is those account setups. They aren't always thought out. They don't, people who are making these decisions don't realize how important it is to break it down by that detail. I'm always happy if I get state broken down by gas and diesel and one lump account for environmental fees, but that's not ideal. The more granular you can get, the more that software allows, the better off you will be long term. And it'll save you some sanity so you don't get one lump sum account that you're trying to reconcile. Which,
And to your point, right? I mean, there is software out there. We have a tool, Reconcile X, where we can, if you've got your general ledger and it's BOL driven for your receipts and your disbursements, we could actually do a quick reconciliation using that tool and identify any discrepancies sooner rather than later, right? Because you don't want to have to pay a tax that you don't
mhm.
owe, then file for a refund, and then have to resubmit a return and then file for an amendment. I mean, you want to try to keep those to a minimum, and that's the way to do it. Reconcile beforehand.
That sounds a lot better than the days when I used to here are the VLLs on my return in my Excel workbook, here are the VLLs in my source system, flag yes or no, which flows in rather nicely to our next topic with manual workflows and oversight gaps. I love this because when I started my career, everything was paper and they would print everything out. The company that I worked for was in about 50 states. We'd all go and we'd get our stacks of paper for our state and bring it back. And you go through the paper and you were ticking and tying. I glad that I'm no longer part of those days. When spreadsheets came around, pivot tables came around, I'm like, this is the future. And it was for a period of time. But even with spreadsheets, what I notice when we go in to help a company, they're like, yep, we never had anything. Then a month later, because somebody left, they all of a sudden discover this person did have a workbook, but somebody broke the macro that made that entire workbook work 10 years ago. So the workbook's no longer relevant. So it really kind of leaves companies in a bad position, especially, Bob, I think you had a great article that came out. I'm probably going to misquote it. The silver wave, was it? Where
Silver
you're seeing a
tsunami.
lot of retirement happening in the industry. A lot of new people are green coming in. Trying to understand somebody else's thought process in a spreadsheet that's not standardized across the board is complicated. The other thing that I want to mention is even when you get a company to invest in a software or some way of doing it better, you need to make sure that all the employees are equally invested. Because I will tell you, going back to that company that I worked for, we did a major software implementation. It cost the company a lot of money. They got all the bells and whistles. Everyone was really excited. And I still saw Mary taking her cart and running past me trying to hide that she still was going through those stacks of paper because she didn't trust the software. So it's not only getting the latest and greatest, it's also getting buy-in from your employees and making sure they're trained and they feel comfortable working with it.
So, just to, piggyback on what you're saying, right? Calendars, tax calendars, right? Give
Yes.
You need to have a generic one that everybody can work on. Not everyone have their own little tax calendar within their own little cube. Um, one of the problems you run into, like you said, right, with my article on the silver tsunami, when you've got leaving or you've got people going out on vacation, if you're not invested in what they're doing and you're busy with your own work and you miss a deadline for a refund, right? And I'll use the refund of the federal form 720, right? That's a classic. Um, Gasoline, you can only file for a refund on any gasoline sold to state and local governments, et cetera, that would be exempt from tax once you hit a $750 threshold, right? But that also has to be filed by the end of the second quarter, right? So you only have, if you're filing in January or you have these transactions in January, you have to file that refund by March 31st, that first quarter. That refund has to be filed by June 30. You only have that one subsequent quarter to get that refund filed in. And I've seen people that have gone on vacation or they've gotten sick, or maybe somebody wins the lottery and they give up their job and they don't come back to work anymore. And all of a sudden you find out that this refund wasn't filed for. And then you go and you file for the refund, or somebody files for the refund and just throws it out there saying, and they backdate the forms or the Excel spreadsheets, right? There's no accountability because now people are just, manipulating what they currently use. And then all of a sudden you sit back and you get a denial letter from the IRS saying this was filed in July, right? July 7th to be exact, right? Now you're out of pocket, right? There's no refund provision. And when you're selling to state and local governments and cities and towns, you could be talking two, three, four, $500,000 that you could be out of pocket. And there's no way for you to get that money back. Zero, right? So that's just a bottom line hit to you, period. So when you're dealing with missed deadlines, when you're dealing with, an Excel workbook or, as a tax calendar, nobody has visibility into that except for the person using it, right? So you need to have some sort of a tax calendar that will say, hey guys, this is, or you as a tax director or tax manager should be able to go into a workbook and say, okay, where do we stand this month? Like what's left to be done? Where are we within this process? How do we get this over the finish line? How do we get it reconciled and filed prior to the due date? These are all issues that need to be addressed and need to be looked at. And again, be proactive. You don't want to be reactive.
And that just reminds me, going back to the federal refund. I remember there used to be this Excel calendar and it would have everyone's initials, and everyone was just focused on filtering by their initial. They weren't worried about anyone else's work. So let's say Jean retires in January 2025. Nobody's paying attention. I look at the calendar and I pat myself on the back because in November 2025, I realized there's a refund we should be filing for. So I filed that fourth quarter 2025 refund, feeling really good, not realizing that I just lost all those previous refunds because it cut it off right there. So
Yep,
there's a lot of risk. You risk people deleting things, thinking that they're doing the right thing. Um, yeah, it can get messy real quick to say the least.
absolutely.
All right, so we are going to move forward with what does your modernization path look like? Bob and I have talked a lot about the issues. We talked about some solutions. Where are you guys at right now? Are you crawling? Are you still doing things manually? Spreadsheet driven, loving those pivot tables, no judgment. Are you walking? Kind of working towards automation, doing a little bit of reconciling, a little bit of work
Kind of,
there.
kind of in between walking and running, maybe jogging.
Jogging, yeah, like a nice steady, maybe like a nice little speed walk with the arms moving. You got the workout going. Or are you running? Everything's automated. You want to talk about AI. You want to see what the future looks like. You are cutting edge. So, Nick, take it away with the next poll.
All right, everyone, there should be a poll popping up on your screen. Give everyone a little bit of time to answer this.
All right, we got some walking. We got some running, which I don't actually run in person, so Probably more that speed walker.
Speed walker.
Moving. Yes. A little bit of a jog. See if we get any more responses. All right, so it seems like, based on what I'm seeing, Bob, a lot of people are in that middle area, which
Yeah, a lot of
is,
people are walking right now. Yeah.
we do have a crawler. That's okay. Spreadsheets can sometimes work, especially if you don't have a lot of data.
Absolutely. Got to start somewhere.
Exactly. So it looks like everyone's just about at that walking stage, which, is a good place to start.
Okay, excellent. So we want to leave plenty of time here to open it up for Q&A to the audience. Please post your questions in the Q&A section. It should be on the top ribbon. You can type them in there. But while we're waiting for some questions to come in, so Kelly and Bob, kind of one thing that Bob, you tied back on one of the last slides, you kind of associated two different things with each other, right? The reconciliation, finding, a diversion, I think was the example here. And there was a lot of discussion around, amendments and the problems around amendments. If you're doing a lot of amendments, what's the natural outcome of that? What are you going to see more of if you're doing a lot of amendments?
I
You
would say
asking
an
me?
audit.
I would agree with you. That's a notice, red flag for auditors to say, you know what, we have amendments on a monthly basis consistently. They're missing other items too. So we're going to go and do a full-fledged audit. That's exactly where my head went with that. Yes.
Yeah. And then, amendments and audits, how do those typically impact a tax team, the folks that are having to file every month?
It spreads them really thin, right? Because now you've got one less person trying to get returns done, and you've got somebody else trying to pick up the slack so that you can address and get all the supporting documentation that auditors are requesting. Auditors are not very friendly when they come in, especially in a case like this. They don't really understand. Well, I'll go on a limb. They don't understand the human aspect of people in their lives, right? I mean, not everybody is focused, 24/7 on their job, right? They do have family. There's work-life balance. You can only put in so many hours before you start seeing double, triple, and to provide information and to have to go to an offsite location to pull certain documents can be very time consuming, number one. And then when you do get all that information, then you have to sit there and you have to walk through the process with the auditor of your thinking on how you use those documents, right? Because we're going back to a time where everything I used to do was paper, and Kelly used to do paper. I mean, we have come full fledged now, right? Now we're into automation. So now it's probably not as difficult. But again, I try to let auditors know all the time, especially when they take a training class, the best time to reach out to any taxpayer would be the last week of a month. I said, if you reach out, between the 5th and the 15th, don't expect an answer from them until the end of the month or the beginning of the next month, because that's their breathing spot. That's where they can start to breathe and they can look at a question and they can answer it. Prior to that, they're swamped just getting returns done, trying to capitalize on all of their collection allowances, administrative discounts, all the timely filing, reconciling general ledgers, trying to correct any and all amendments that might have happened from the prior month. I mean, there's a lot that goes into a tax manager or tax director's job on a day-to-day basis. And that's kind of where I see a lot of the problems. I mean, I don't know about you, Kelly, but
Uh, I agree 100%, Bob. And I think two more things come out of that. Number one, if an auditor is coming in, like we all deal with audits for different reasons, sometimes it's cyclical, sometimes it's just desk audits. But if an auditor is coming in because you're filing a bunch of amendments, they're not coming in thinking everything's okay. They're coming in with a negative mindset already. You are off to a bad start. And then
right.
on top of that, we are switching over to this digital age. And what I'm seeing is auditors aren't like, okay, great. Now we'll take what we had before. They want more. They know you have more. Now they want more. They want to see the BOLs. They want to see the invoices. Their sample size grows. And even though we're able to get them that information quicker, it's still the same process of reviewing the documents and understanding what's going on. So an audit can take one of your team members who's still responsible for X number of returns and just drown them. Because also chances are when the auditor comes in, unless you convince the auditor to include current periods, you're probably still amending. That doesn't go away.
Well, you're right. And one of the things that I've noticed, in the consulting aspect of what I used to do is that if you were going under audit for amendments, the auditors would come in and they would reconstruct every single tax return for the entire 3-year period. Because if you had to amend once for a transaction, their feeling is there's a lot more that needs to be fixed. And they're not going to give up until they've reconstructed every one of your tax returns. So if you've got that kind of time to sit there and spend to get 36 more tax returns done, and in some states it's 48, your time is limited, very limited.
Absolutely.
We do have a question from the audience, and the question is that Indiana use tax has probably been one of our most frequent amendments. Is IGEN prepared to change for the change this particular return starting January 2026? And Bob, I am not familiar with that particular change, so maybe you know.
I believe that changes. They're no longer doing every 15 days. I believe it's just going to be once a month now. And yes, we are on top of it.
Yeah,
Excellent.
and the
I
reporting's
figured
a
as
little more
much.
streamlined as well. They're getting rid of the schedules that were involved in the other return. We'll see what their
Yep.
final product looks like, but it should be better for taxpayers in general.
And for anybody
That's
on here
always good.
and for anybody on here with Michigan, we are fully aware that the prepaid sales tax has gone away January 1, and it will now be part of the motor fuel component. And we've already got that issue addressed as well. So there should be no issues there.
All right. I have another question for you. What is everyone planning on doing with the I think it was Oregon's rate change on December 31st?
Great timing.
That's a good one because I told Kelly about that one.
You did, and I wanted to cry.
I got a call. I got a call from Oregon because I'm very good friends with Jessica over there, and she said to me, "You're not going to believe what happened, but a legislative session went into session a day before it was supposed to, and they passed the rate increase, and now it is going to be effective on December, I think it's 29th." And we on a tax determination side, we have no issues with that. We're not exactly sure how the state yet wants to see it on a generated form that is going to be produced. In my conversations, Oregon is looking at providing some guidance, but right now they're looking at moving them to an other schedule so that they can identify those transactions on those date or on that date. So again, until we get further information, we can't do anything on our end. We're hoping some of our filers that use Oregon will send us any information that they get. But I am in contact with Jessica Stafford, and she does send me whatever she can when she can. But again, she's just in the audit division, so she may not get it before the taxpayers. So that's kind of where we're aware of it.
And
I
I've
think
seen this
many
with
are.
what was that, Nick?
Oh, sorry, Kelly, go for it.
I saw the same thing happen with the New Jersey petroleum gross receipts tax. They changed over at an awkward time, and you had to file using the old report for that period and the new report and hope that everything was caught. So we always try to give the states a little bit of grace. Obviously, our contacts are not the ones making these decisions. There are people making these decisions who are not aware of the consequences. I know Delaware ran into it with jet fuel. Shoot, we even saw it with the Superfund tax, right? That came out from the IRS. The IRS didn't have a lot of time to give a lot of guidance. So everyone was kind of trying to figure it out as we go. It's definitely a challenge.
Well, case in point, look at the when they had the gas tax holidays, right? Georgia decided in the middle of a month, let's just stop charging tax. so that our taxpayers, our consumers will feel the effects of getting a tax relief. I don't know how well that went over, but I don't know if anybody ever felt a relief from it, because you had that going on in Georgia, which was in the middle of the month. I believe Maryland was probably the only state that actually did it, but they did it on the first day of the month, which kind of made life a little easier for everybody. But again, when you're doing a tax return, how do you show your first 8 days of taxable transactions and then your last 12 days, 20 days, 22 days tax free? I mean, it just makes for messy reporting.
And then you also have to keep your ERP system up to date to properly
Exactly.
charge the tax and make sure you're on top of that. And I don't know if it was Maryland or Georgia, I won't call either of them out. One of them like released it at like 11 o'clock at night to go into effect the next day or something crazy like that.
That was
So
Georgia. I'll
it
I'll
was,
call them
yeah.
out.
Sorry, Georgia. Yes, it makes it a really complicated situation that goes from beginning to end. Tax reporting is always the last piece of the puzzle. So if you're not getting it right in the first part, you get to the reporting part and it's already a nightmare.
Absolutely. All right. Okay. Well, thank you. Thanks to all of the attendees for your time, and thanks to Kelly and Bob for presenting. This has been great. If you have any questions, want to talk with an expert, there's a QR code and there's links to the iGen and Weaver website. I appreciate everyone's time.
Absolutely.
Yes. Thanks, everyone.
All right. Have a great day.
Mm.